The so-called doom loop refers to the multiple linkages between banks and governments, arising when banks in a country hold a significant amount of the sovereign debt of that country. In this podcast, Bruno Maria Parigi, professor of economics at the University of Padova, discusses examples of the doom loop in Ireland and Greece and how they affect risk transfer. Furthermore, he outlines how public authorities can intervene in private banks and how the cost of these interventions are allocated. This podcast was recorded at the European University Institute in Florence, Italy, in the occasion of a course on the Models for Financial Stability and Prudential Policy held in February 2020 at the Florence School of Banking and Finance. Professor Parigi, thank you very much for being with us here in Florence, and you just now taught a course on the concepts of principles and models which are underlying the prudential regulation of banks. And in particular, in your lectures, you started by giving the definition of the doom loop. So could you remind to our listeners as well as to the participants in this course, what is it, the doom loop, and how does it almost start?
The so-called doom loop refers to the multiple linkages between the banks and their government, that they arise when the banks in a country hold a significant amount of their domestic sovereign debt.
And could you provide perhaps a few examples from the recent history?
But a couple of recent examples could be Ireland, where the government had to guarantee the deposits of major banks under stress, and the opposite, Greece, where banks holding large amount of government debt of their country suffered as a result of the huge losses on their sovereign debt.
And how does this doom loop affect the transfer of risks?
Well, the risk transfers essentially take place through two channels. So in the first channel, an important shock that lowers the value of the sovereign bonds lowers also the value of the assets of the banks that hold them. Consequently, the equity value of those banks is going to decline. Mm-hmm. All this makes banks riskier and increases their funding costs. Now, as a result, banks are going to lower credit to the real economy and or are going to increase the rates at which they lend to the real economy. This is going in turn to lower the growth of the economy and eventually is going to lower tax revenues, making the fiscal position of the sovereign even more stressed. Mm-hmm. So this completes the first loop, the first channel. The second channel instead deals with the guarantee that the sovereign offers to bank liabilities, mainly in the form of deposits guarantees. So if the bank is distressed as a result of the shock of the sovereign debt that it holds, so that's the first point, now it's more likely that this bank may need the government assistance, for example, using indeed the government guarantees on its liabilities. So this is going to increase the potential cost of the government and contributes to deteriorate its fiscal position even further. And this also closes the second loop. Obviously, these two channels tend to reinforce to each other, making the story indeed a doom loop.
Indeed it does. And another important point that you touched upon in your lectures is the relationship between sovereign risk crisis and the risks of the banking system. So is it, in your opinion, sovereign risk that makes banks riskier and introduce less lending, or is it the other way around?
Now, in the two examples that I gave you before, Ireland and Greece, causality is straightforward to identify, from banks to sovereign in Ireland and from sovereign to banks in Greece. However, in general, it is more difficult to determine the causality link, that is, whether it's a sovereign risk that makes the bank riskier or the other way around. A number of studies that are using econometric techniques show that in most cases the link is from the sovereign to the banks.
Interesting. And now moving on to the concept of bank resolution, could you outline how public authorities can intervene in private banks and how are the costs of these interventions allocated?
Now, the guiding principle should be prompt intervention without allowing that the bank situation deteriorates further. Now, early interventions include, for example, the removal of the top management of private banks, even private banks in serious distress, which importantly involves no fiscal cost. However, what we observed in the reality of bank crisis management since the BRRD was introduced is that the authorities involved have been very slow to act, perhaps trying to buy time, in the hope that the problem might go away by itself. So part of this conduct may be explained by the difficulty to implement the very rigorous discipline mandated by the introduction of the bail-in regime that requires that also subordinated bondholders, senior bondholders, and large depositors bear the losses of the bank of which they are creditors. Now, in these years, the resolution procedures envisioned by the BRRD has been indeed battle-tested in a number of cases and in a number of countries. And to me, it becomes more and more clear that imposing losses on bank creditors according to the hierarchy of the bail-in regime is politically difficult. So the dilution of this regime may have consequences on the ex-ante risk-taking of the banks and on the ex-post resolution of the crisis.
Right. And final question to wrap up this podcast. Let's look at the possible options on the table as well as for us the future. So could a common European safe asset contribute to solve this doom loop that you just discussed, or how would that work in practice?
So I think that to answer your question, we have to start from the fact that around the world there is a scarcity of safe assets. Now, safe assets are assets which are capable of maintaining their value and their liquidity in situations of systemic stress. So in this context, a European safe asset along the line of the SBAs could help. This security could be constructed by pooling sovereign debt of all the Eurozone issuers, hence it would benefit from diversification, obviously, and could also tranche its cash flow from sovereign debt interest so that the senior tranche would have the status of a safe asset. However, banks would have the incentive to hold this senior tranche only if the risk-weight criteria for holding their sovereign debt are indeed changed. And only in this case the doom loop could be weakened significantly.
Well, thank you very much for your explanation. It was a pleasure having you here.
Thank you. It's my pleasure.
Thank you for having listened to this podcast by the Florence School of Banking and Finance. For more information and to listen to all our podcasts, visit the webpage fbf.ui.eu/podcasts.